HealthiosX webinar series. My name is Scott Jordan. I'm the founder of HealthiosXchange. HealthiosXchange is the premier investment marketplace dedicated exclusively to the global healthcare industry, employing crowdfunding as the cornerstone of a new funding paradigm. HealthiosXchange offers direct access to the broadest opportunities on a fee-free, carry-free basis in the most trusted online environment. If you have any questions, please submit them by entering them into the chat box. Steve and I will be answering questions throughout the presentation, including a brief Q&A session at the end of the webinar. Our agenda for today, there's eight different segments here. First of all, I'm going to have Steve Engle introduce himself. Then we're going to get into what the definition of no fee, no carry means. Then thirdly, legislation fueling this move to no fee, no carry. The challenges and opportunities in healthcare investing, why accredited investors are attracted to no fee, no carry, why no fee, no carry is important to company. We're going to touch on HealthiosXchange, which is our healthcare crowdfunding portal, and then some contact information if you guys would like to get a hold of us. So having said that, let me introduce Steve Engle. Go ahead, Steve. Tell a little bit about your background and what you're doing.
Thanks, Scott. I appreciate being here with everyone. I have currently being an advisor to life science industry companies in a number of different areas because of my long experience in the biotech area. I was previously head of Xoma, which is a leader in the antibody therapeutics area. In addition, at La Jolla Pharmaceutical in San Diego, and also worked on the nicotine patches. If you've used those or you know someone who's managed to suppress the use of cigarettes using them, that's my product. And you know, I've been a board member of both the public companies as well as also of Bay Bio, where I am a current board member, and also a board member of Bio, the International Trade Association, and Biocom in Southern California. And probably the most relevant thing to this is that over a 20-year period of time, I probably raised over $300 million in both private and public markets. And as we all know, this has been a very unusual time, and the crowdsourcing approach seems to offer a real good solution to the problems we've been experiencing most recently. So on the next slide, as you can see here, this is just some general areas that I've worked in, and my firm continues to help people out in this area, including board membership and financing and strategy and operations as well. Next slide.
Thanks, Steve, for joining us. So what is no fee, no carry? So when we take a look at this, essentially in investments in emerging growth companies, typically what you see out there is the companies, emerging growth companies seeking to raise money have to pay a retainer to investment banks. That can be anywhere up, you know, I've seen $15,000, $20,000 a month for 6 months. Sometimes it's taken off the success fee, but then when there is no success fee, some companies are left, you know, out $90,000. So no fee, no carry. The no fee side means no retainer, means there's no 2% management fee, which you typically get when you invest in VCs. They, you know, you give them $1, they give you back 90, or they invest 98 cents. 20% carry. That's basically, you know, the VC firm will get a 20% carry on the exit value. The benefits of no fee, no carry, first of all, heightened IRR. You know, investors basically get a better return from the standpoint that there is no carry and there is no upfront fee. Shared risk alignment. The 2% can be very disingenuous from the standpoint that the 2% encourages VC firms to basically have huge funds. So if they have really large funds, that means they can't put enough money into a small company to make it worth their while. Thus, part of the reason for the innovation gap. Global gateway for accredited investors, meaning direct investments. This is a direct investment if you're an accredited investor. Essentially, you're investing directly in a company without paying any of these fees, which obviously heightens the IRR. And we're not disintermediating the investment managers. We come from, our parent is Healthios, which is a Chicago-based investment bank focused, excuse me, on raising capital from venture capitalists. So what we're trying to do, even with them, is to make it easier for them to deploy capital. And they lose deals as well. They can't finish off their syndicates. So we can allow accredited investors to invest alongside of them, which is on our Express portal. And so that's a real significant advantage for the VC who can close around, and a significant advantage for the investor that doesn't have to pay the VC 2 and 20. So when we take a look at the legislation fueling no fee, no carry, it's really the Jobs Act, right? So you know, there's some information today or released today on Title III, which is essentially raising money from non-accredited investors. But we at Healthios and HealthiosXchange are focused on raising money from rich people. So it's Title II, accredited investors. That's our focus. But the Jobs Act has really opened the floodgates to direct investing and no fee, no carry. The second point down, it's lifted this general solicitation ban, which has been with us since the Great Depression. That way I can solicit investors that I don't know, which is great because you can leverage the social media tools like Facebook, LinkedIn, etc. It raises the shareholder cap from 500 to 2,000 before you have to become public, which is great when you're trying to raise a small amount of money from a large group of people, which is the definition of crowdfunding. Increases the limits on Reg A, so you don't have to file SEC documents. You can raise up to $50 million. It's a substitute for an IPO. Legalizes crowdfunding. This is Title III, and assists with some of these funding platforms. Kickstarter, by the way, has raised $815 million in what they call rewards-based crowdfunding over the last few years, which is really exciting. The crowdfunding targets that we have on no fee, no carry, there's punitive, we call them punitive fee structures. And by the way, we've raised money from venture capitalists as well. But some of these, where is crowdfunding targeting? What slice of the pie do they want to take? So from a crowdfunding perspective, if you take a look at the Reg D industry, you're talking about $1 trillion industry. And the problem with that is usually dominated, by the way, with oil and gas and public non-traded REITs, is that there's excessive fees that come out of the front end. Secondly, angel investing, you see $22.5 million invested in 2012. Angel investors do a nice job, but there's geographical boundaries because, I live in Kansas City. I can't invest in a deal in San Francisco or be part of an angel group. There's annual dues, which can be problematic. You have to participate, et cetera, and very high investment thresholds. The venture capital side, they have the 2 and 20, which has been shown for the Kaufman study that it doesn't work very well. The average VC after fees doesn't outperform a passive ETF. So these are big markets. You don't have to take a very big piece of these to making meaningful impact in crowdfunding. So the challenges and opportunities, I'm going to turn it over to Steve real quick. We're going to go over a series of slides. Go ahead, Steve.
Right. So first of all, when biotech is in its tough times, as I think most people would think about it this last couple of years after the financial crisis, it actually turns out to be a great time to invest for investors because the rates and so forth are somewhat lower. So, what you're seeing is the more seasoned kinds of ventures coming out. What's been nice this year has been to see the biotech index up almost 50% as compared with SP at 23. So we've seen some really good things on the public side. The question is, how do you get in there earlier? And on this slide, what you'll notice that, as we say at the top, the investors like healthcare in general, and that's shown by the ranking of these different evaluations of interest. However, they've been very limited funds, and in particular about 8 million accredited investors in the U.S. 41% have invested in VC-type funds, but only 5% directly in the Reg D offerings. Next. Next, yeah. So why are the participation rates so low? Well, first of all, there's some challenges associated with investing via the angel groups. Often, and probably primarily, the investment thresholds are too high for the level of risk. And we know from working in biotech for many, many years that the odds of any one product making it through the system are low. And even in companies, there's a need to diversify. And the issue can be that diversification is difficult given the minimum investment requirements per company of $25,000 or so. Also, there are annual dues many times, which can be problematic in terms of your return, and the angel groups often require members to attend meetings. There are also challenges with raising small amounts of capital per investor because the companies are just not interested in accepting investments under 25K. One of the things this does from their side is it creates a very fractured capital structure, and it's just much harder to deal with. Next. So crowdfunding enables direct investing. You're not required to pay annual dues or participate in groups. The investment thresholds are as low as $1,500 per investor, and that's an awfully nice situation. The aggregate investors into SPVs, and so by aggregating, you're able to see it as one shareholder rather than having to manage many. It also eliminates certain geographic barriers. We're certainly aware that San Francisco, Boston, San Diego are the centers of biotech innovation development in the United States. And if you're not within those areas, it's pretty hard to participate as an angel. And finally, what's being provided here through Healthios is platforms that provide the legal and diligence, escrow, and payment systems that are necessary to be able to actually make the system work and work reliably. Next. So why are accredited investors are attracted to this no fee, no carry? Next. This 2 and 20, it really does impact the returns, and this is based on a Kaufman study where Kaufman had covered a number of years to get the information and is a very active fund in the biotech space. The average VC fund barely managed to return investor capital after all the fees were paid during this period of time. And from 1997 to 2009, only 5 vintage years occurred in which median VC funds generated IRRs that returned investor capital. So you can see part of the problem already. In the Kaufman portfolio, only 20 of the 100 venture funds generate returns that beat a public market equivalent by more than 3% annually. And of course, those funds, as you might guess, end up being hard to get into many times. The VCs are incentivized to raise large funds. That's what the 2% that they're receiving on an annual basis for managing that fund is all about. The big funds are reluctant to invest in early stage companies because they really can't put enough money to work because they can probably only do 20 deals a year depending upon the size of the fund, and they really have to focus to find those, and they've got to be large enough to really make sense in terms of the amount of money they can put to work. Also, in Kaufman's portfolio of 99 funds, only 16 generated a 2x or greater net multiple compared to 50 funds that failed to return the firm's capital. So again, you can see a certain issue in this approach. The majority of funds, 62 out of 100, failed to exceed returns available from the public markets after the fees and carry were paid. And so this is one example, so we have to remember that, but it's indicative of the kinds of issues you run into with a 2 and 20 type approach that is normally used with the VCs and other funds. Next.
Hey, Steve, we got a quick question here. It says, I'll take this. It says, will you address special purpose entities to rationalize the capital structure? So essentially, VCs don't want to see 2,000 investors on your cap structure. You've heard a lot about that. So what's interesting is you lower the investment threshold, and you're able to put, under 100 investors into a special purpose vehicle that feels like an LP. It has one shareholder. It's one shareholder vote. It has there's one lawyer, one administrator. So it's real easy for the company to deal with that group, and it's also more favorable for following capital like venture capitalists. Go ahead, Steve.
So why is no fee, no carry important to the companies themselves? So first of all, it's basically lower fees. The early stage companies are struggling to raise capital inexpensively, and the traditional investment banks, if you can get one to be involved, will charge some kind of monthly retainer. 10 to 15,000 is common. Also, there are success fees that can range from 7 to 10%. The warrant coverage can be onerous as well and really bite into the overall equity ownership. This also, you're seeing that you're trying to attract investors seeking higher IRR, and you're trying to make sure that the full equity is being returned, and that's what the new system provides over the old. When you've got the 20% of the 2 and 20, it can significantly lower investor returns. Next. So the crowdfunding capital approach fills the innovation gap. As we know, with the 80-20 rule, 80% of the capital is raised by 20% of the firms. And one of the issues is that a small number of firms in the last couple of years are really the ones that are active, people like Third Rock, Sofanova. And then they're mostly, as you look at them, there have been a few new of the firms that have raised new funds for earlier stage, like 5AM and to some degree Frazier. So these firms are also being able to bring money in, but in fact it's not a large number that are active right at the moment. And so it has really created a crunch. Even if you can get friends and family to get the company going, the reality is that at that Series A type round, there's a real issue. Also, when you look at getting the funding done, and I've been in these conversations directly, you usually have to get multiple VC firms, all of the same quality, that is, who are very active, because the one firm doesn't want to be in there without knowing the others are going to be able to be strong enough to carry this through past that first round. The other sources of capital are being accessed, but they are somewhat constrained. The grants through NIH and other areas have been somewhat slowed down because of the sequester. The patient advocacy firms or funds have stepped up, and they are a key source of capital. But again, it's not a normal route, although it is an emerging way to do this. But it's another opportunity, but it does take time to get in and make something happen. And then finally, the capital is not evenly distributed. Again, we have these geographic barriers between Boston, San Francisco, and San Diego, and the rest of the U.S., and who can actually get access.
Thanks, Steve. Appreciate that. I thought I'd take just a short amount of time to talk to you a little bit about, this crowdfunding portal, HealthiosXchange, which I'm the founder, and Healthios has sponsored. This is a vehicle that incorporates no fee, no carry. It's essentially, it's a very, very in-depth, portal. It's got a lot of community. I say it's almost like LinkedIn and Match.com and AngelList, because on the LinkedIn side, it has friending, following, sharing, and messaging opportunities where you can build relationships with venture capital, capital sources like family offices, strategics, large pharma, biotech, et cetera, foundations. It's Match.com because we tag data and we bring investors to your deal. So if they put oncology in their description, and you're an oncology company looking for money, instead of opportunistically trying to find that individual on a golf course or through a referral, we essentially bring them to your doorstep. And AngelList's doing a nice job in San Francisco and of allowing everybody into the portal. So it's not there's no selection bias, where we're only putting certain companies on the portal. So we think that's a very important quality. Transforming the markets is 3 pillars. It's open access, like I just talked about. There's a scoring component, which we'll talk about in a future webinar, which we assist our accredited investors with making better investment decisions. So on the HX scoring side, each company has a score. Each one has a page. And we also are fee-free, carry-free. We're not charging retainers or carry, and it's a 5% success fee from capital that is raised via the portal. It's obviously there's a big continuum here. The average, I should say average, but the emerging growth companies overall, they're successful, raise about $49 million in capital on the biopharma side, and that's over a 5.7 period of time. We don't think crowdfunding alone can get our companies to the finish line. Thus, you need venture capital, angels, foundations, etc., to get you there. So we think it is a capital continuum. We're just trying to get companies to value inflection points. 5,000 over 5,000 companies are in the portal. Some are pre-populated, like company pages in LinkedIn. Some are actually people have taken ownership of those pages. Essentially, when you think of LinkedIn company page, there's all that functionality of sharing and following, etc., communicating in a Q&A forum. 46 market sectors. The 5,000 emerging growth companies are placed in one of 46 market sectors. You've got pharmaceuticals. Underneath that, you got oncology and CNS, etc. You have medical device, like cardiovascular devices, and then healthcare services. Our constituents can create watch lists so they can follow companies and get catalyst updates, which is very nice. And it's really nice for companies from an IR perspective because their followers can get real-time updates on things changing in the company. We will have 1,000 investors in this portal right now. I mean, we launched 2 months ago, and we have over 1,100 members. Those members are accredited investors, emerging growth companies, strategic buyers, and investment professionals. We've got a lot of strong functionality in here, this HubSpot system and whatnot, inbound marketing, very comprehensive engagement procedures, and we have a full custodial escrow transaction reserve system for meeting compliance under the New Jobs Act. We have a very robust research platform. We have our own research. By the way, our own research is not the buy, sell, hold you typically see. It's quantitative type. A lot of our feeds, like from Pharma eTrack and CIQ, we try to show not only a company score, but also capital flows and activity, M&A activity, and venture activity per market sector, those 46 market sectors. So a very strong research component to support each company in the market and the respective market sectors. Our scoring, just real quick, 104 discrete quantifiable measures. So in this case, these are statistically correlated to key success factors, which is usually IPO, M&A, or partnering. There's a lot of algorithms going on here. You will never get it right. We just want to get it as close as we can. So top quartile companies can be scored, or can be top scored companies can raise capital, or you can be sponsored by a capital source, but we're not going to be raising money for all companies. That's the kiss of death, given the fact that 30 to 1, it's 30 to 1 odds in biotech that a company actually achieves success. So we can't do that. So we have HX scoring alerts. We have all these different, you can take a look at some of the other parameters there. This is company page. This is probably one of the most important slides. This is what a company page looks like when an accredited investor comes. You've got a score in the upper right-hand corner. You've got fundraising targets. You've got deal points. In this case, the minimum raise would be more like $500,000, not a zero. You have Invest Now button where they actually go in and put the amount of money. Like say they want to put in $5,000. Then they go and that money goes into escrow, and if you hit the minimum, that's released to the company. We get 5%. You'll see followers down here. They get the catalyst updates. You get a description. You've got highlights, Q&A, talk with management. The public documents, you can get confidential documents with an assigned NDA, and there's video and other things on this. But very comprehensive page, very exciting. We will tell you who comes to your page. We'll drive people to your page. Payin meets online. We have partnering conferences at 14 historical conferences. You'll see some of the metrics there, but we do like a bio partnering forum, and that's very good. So partnering is a big part of this portal. It's not just raising capital. So that pretty much sums it up on no fee, no carry. I want to thank Steve and everybody that joined. If you want to get in hold of Steve, go ahead and give. Here's his email address right here, and myself. This is me. Anyway, we appreciate your time. Thank you, Steve, for joining us. And we'll go ahead and send this presentation, and we encourage everybody to friend, follow, build up your page, and use best practices on the portal. Thanks so much. Bye-bye now.